Hello, this is Joe Pryor of the virtualrealestateteam.com in Oklahoma City. It's December 2015, and guess what? The Federal Reserve, the organization that's like the little boy that cries wolf, every time that they meet say we're going to possibly raise interest rates, and they don't, and they've done this for the last 9 years, finally did it. They finally raised interest rates a quarter point. Whoopee. All right, what does this mean? I mean, a quarter point doesn't sound like a whole lot, but after 9 years of pretty well zero interest rates for the banks, it's kind of a step. It is something that indicates to us that the market may be just a whole lot better than we thought it is. Now, I understand that some of you out there may still be suffering, that not every area of the country, not every career path that's out there in the United States has gotten back to what it should be. That real income that you experienced before 2008 is now back to where it used to be with the rate of inflation. So I'm not trying to tell you here that the world is perfect, that the United States is perfect, and everything is okay. But we are creating a tremendous amount of jobs. Unemployment has gone down tremendously. People looking for jobs, because this used to be a problem. There's some people that just opted out. They are looking for jobs, and they're finding jobs. And so we have, in the last 5 years, created the most amount of jobs in the history of the United States. So we're well on our way to recovery. And what the Fed is trying to signal is that, inflation is out there. Don't think that it isn't. In fact, probably the biggest factor right now masking inflation is the fact that oil, which was above $100 a barrel, is now trading at about $37, $38 a barrel. Now, we know it's going to go back up. But when you think about that dramatic drop, when you think about having the price at the pump cut in half, in some cases more, then we understand that that's a volatility that should be taken into account. And the Fed did take it into account. And we know that that's going to rise. And the Fed knows it's going to rise because that's what happens with commodities. In fact, one of the estimates is that oil will be at $55 a barrel before the end of 2016. Still way below those highs of $75 to $100 to $130 a barrel, but still increasing, and that is inflationary with everything else. So expect some more price increases at the Fed window coming up in 2016. But also understand that first and foremost, what this is going to do, it's going to affect how much the CDs that you can buy at the bank pay. They're going to affect the fact that when you go buy the car, unless that automobile industry manufacturer is willing to really cut you a heck of a deal, that it's going to be higher interest rates on short-term loans. Long-term loans is a little bit slower, and in fact, in some cases, it can react against it. Sometimes, actually, the long-term rate goes lower. But that is where inflation is a huge deal, because if you're buying a 10-year note, a 30-year treasury bond, whatever it happens to be, those long-term rates are very, very sensitive when it comes to inflation. Right now through 2016, immediate inflation doesn't look like it's on the horizon. So for mortgage companies, this is good news. For those who want a fixed 30-year rate, not an adjustable rate, which will be affected, this is good news. But you need to watch it, because the home that you want to buy in 2016 may just have gotten a little bit more expensive for you. We'll monitor this. I'm going to be talking about it at least once every quarter. Let's see where we are. Let's see where inflation is. Let's see where mortgage rates are. This is Joe Pryor of the virtualrealestateteam.com in Oklahoma City, where we deliver traditional real estate values at the speed of technology.